you're here, ready to go deeper. Excellent.
Yeah, perfect.
That's exactly what we do on the deep dive. You send us your sources, articles, reports, fascinating bits and pieces, and we become your guides. We pull out the crucial knowledge so you can kind of get the big picture without having to wade through it all yourself.
And today, well, thanks to the accounting step-by-step guide you shared, our mission is to unravel the often confusing worlds of bookkeeping and accounting.
Yeah, they do get mixed up a lot.
They really do. So we aim to build a strong foundation for you, clarify those essential financial ideas, and deliver some of those, satisfying aha moments.
Nice.
No matter where you stand with financial know-how right now, whether you're prepping for a meeting, catching up, or just curious, we're going to get you informed without hopefully overwhelming you.
Okay, let's jump right into it then, because like you said, you often hear bookkeeping and accounting used as if they're the same thing, but, well, they really aren't.
Not at all.
Think of bookkeeping as the really detailed work, right? Noting down every single financial transaction a business has.
Exactly.
It's about making sure all those comings and goings of money are recorded accurately, whether that's, on paper or probably more likely these days in a computer system.
That's spot on. Bookkeeping is the fundamental record-keeping, the process of collecting, organizing, and securely storing all that vital financial information.
It's the backbone.
It really is. The backbone for day-to-day operations, absolutely essential when tax season rolls around, and it's what allows you to create those all-important financial statements later on.
Okay.
And as your guide points out, there are a couple of main ways to do this. Single entry and the much more common double entry system.
Right, double entry. That's one most businesses use.
Yeah, precisely because it has this kind of built-in mechanism to help catch mistakes. It's like having a second set of eyes on your records automatically.
Okay.
Yeah.
And then we have accounting, which is like the broader field. It takes all that raw information from bookkeeping and goes much further, right? Accountants analyze that data.
They summarize it in meaningful ways, yeah, and they report on the results.
So if bookkeeping is the data entry.
Accounting is the interpretation and the strategic use of that data.
Exactly.
Accounting encompasses the entire system, how it's set up, the internal checks and balances for accuracy.
The controls.
Right. The internal controls, the detailed analysis of the financial info, and then producing those key reports we've mentioned, like tax returns and the financial statements.
And accountants often design the bookkeeping systems themselves.
Often, yes. Especially in larger organizations, you can really think of accounting as the language of business. It's what lets you truly understand a company's financial health and where it stands right now.
Okay, so let's really nail down the key differences then. Bookkeeping. Primarily recording individual transactions, all the details, money in, money out.
The granular stuff. While accounting takes that wider view, it includes recording, sure, but then it goes on to measure, group, summarize, analyze what it all means.
And report it.
And report it, exactly, in financial terms.
And typically, you have bookkeepers doing the recording, accountants doing the analysis and reporting.
Generally, yes. That's the typical division of labor, and this is crucial. Those financial statements, income statement, balance sheet, cash flow, those are products of accounting.
Not usually bookkeeping outputs.
Right. A bookkeeper provides the data for them.
Got it. And the accounting insights, that's what drives the big decisions for leaders.
Precisely. Bookkeeping records provide the essential data, but the accounting analysis provides the understanding needed for strategy.
Okay. And accounting aims for that true and fair view.
Yes, that's the goal. To give investors, lenders, anyone who needs to know a reliable picture of the business's financial health.
All right, let's build up that financial vocabulary. Your guide hit some really key terms. First up, asset.
Right. An asset is basically something the organization owns that helps it achieve its mission or, make money.
Like inventory for a shop.
Exactly. Or the stove for a restaurant, delivery vans for a courier, things they own and use.
Okay. And the opposite kind of is liability.
Exactly. That's what the organization owes to others. Wages owed to staff, taxes due to the government, loans they need to repay.
Obligations.
Obligations, precisely.
Then there's equity. This one can be a bit tricky.
It can, but think of it as the owner's stake. What's left over from the assets if you paid off all the liabilities?
Like the part of your house you actually own minus the mortgage.
Perfect analogy. For a business, it's the owner's claim on what the business has.
Income seems pretty straightforward. Money coming in from operations.
Yep. Sales revenue, service fees, whatever their main business is.
And expense is the money going out to make that income happen.
Exactly. Cost of materials, salaries, rent, utilities, money spent to run the show.
What about distributions?
That's money flowing out to the owners or stockholders. Dividends, maybe some types of bonuses, sharing the profits, essentially.
And cash flow. This sounds really important.
Oh, it's absolutely vital. It's the actual movement of cash in and out from operations. Income minus expenses, but specifically looking at the cash.
You can show a profit but still run out of cash.
Precisely. You hear it all the time. Profit on paper is one thing, but you need actual cash to pay bills. Cash is king, as they say.
Right. Okay, then overhead.
Those are the indirect costs, stuff you need to run the business but aren't directly tied to making the product or service itself.
Like the office rent or cleaning services.
Exactly. Necessary, but not part of the core production cost.
And finally, GAP. G-A-P.
Generally accepted accounting principles. These are the rules, the standardized guidelines everyone follows for financial reporting.
So everyone's speaking the same language.
That's the idea. It ensures accuracy, consistency, comparability across different companies and industries. It creates that level playing field.
Makes sense. Now, the guide also talks about different types of accountants. It's not just one thing.
Not at all. It's quite diverse. First up, the CPA Certified Public Accountant.
The top tier.
Yeah, you could say that. They're the experts for complex accounting, taxes, understanding a company's overall financial health, often trusted advisors.
So more than just tax prep.
Oh, much more. Financial reviews, audits, forensic accounting sometimes, strategic planning. Becoming a CPA involves a degree, plus passing that really tough CPA exam.
Okay. Then forensic accountants. The detectives.
Yeah, that's a good way to put it. They dig into records looking for errors, omissions, or, fraud.
Ooh, interesting.
Very. They need sharp analytical skills and investigative instincts. They might work on internal probes, support legal cases, even testify in court, often they're CPAs too, or hold a CFE certified fraud examiner credential.
Right. How about auditors?
Auditors check the accuracy of financial records. Often they're external, meaning they don't work for the company they're auditing.
For impartiality.
Exactly. They inspect the financial statements, look at the books, assess operations, and make sure everything looks right. They also provide recommendations, usually need an accounting degree.
Okay. Management accountants.
They work inside a company, providing financial info directly to the leaders for decision-making.
So internal reporting, budgeting, risk analysis.
Spot on. Planning, budgeting, risk management, profitability analysis, helping managers run the business better. They need strong technical skills and good communication skills to explain the numbers.
Then cost accountants, they focus just on costs.
Pretty much. They analyze all the expenses in the supply chain production, materials, labor, shipping, admin, looking for ways to improve efficiency, cut waste, and help with budgeting. Very detail-oriented.
Government accountants must be crucial.
Absolutely. They track public funds, federal, state, local, making sure taxpayer money is spent properly, legally, efficiently. Some work for the IRS. Auditing businesses and individuals requires a solid degree in accounting or finance.
Project accountants sound more specialized. Freelance sometimes.
Often, yeah. They oversee the finances for specific projects, tracking expenses, invoices, billable hours, making sure it stays on budget. Usually need a degree, maybe a CMA or CPA helps too.
And investment accountants, working with stocks and bonds.
Right. In asset management firms, brokerages, they manage client investments, ensure compliance with regulations, help develop financial strategies, often need an economics or accounting degree, and CPA is common here too.
And finally, the staff accountant. Kind of the generalist.
That's a good way to think of it. They handle a variety of tasks, preparing statements, reconciling accounts, cash management, maybe payroll.
In small businesses, they might do more bookkeeping.
Yeah, could be. In larger places, they might supervise junior staff or specialize a bit more. It's a foundational role, usually requires that bachelor's degree in accounting.
Okay, shifting gears now. Let's talk about what all this work produces. The financial statements. The guide says they're super important, right? Especially for public companies.
Absolutely critical. The SEC requires them for public companies for transparency, but really any company looking for investors or loans needs them. They show the company's health.
And the first one is the income statement. or P&L.
Right. Profit and loss statement, or statement of revenue and expense. It shows how a company performed financially over a period, a month, a quarter, a year, like the score for that period.
How does it do that?
It lists all the revenues earned during that time and subtracts all the expenses incurred to generate those revenues.
Both operating and non-operating costs.
Yep. And the end result, the bottom line, shows the net profit or net loss for that period. It's the key measure of profitability.
What do people use it for?
Lots of things. Calculating financial ratios to assess efficiency, comparing performance year over year. You often see 2-3 years side by side. Investors use it to judge potential. Lenders use it to see if the company can likely repay a loan.
The guide mentions two formats, multi-step and single-step.
Yeah. Multi-step gives more detail. It shows gross profit, operating income, pre-tax income, then net income. Better for analyzing where profits come from.
And single-step.
Simpler, just total revenues minus total expenses equals net income. You don't see those intermediate steps explicitly, but you could figure them out. Depends on what the company wants to show.
Okay, let's walk through the accounts on multi-step one. Starts with net sales or revenue.
Right at the top. Total value of goods or services sold minus returns and discounts. It's the starting point.
Then cost of sales or cost of goods sold.
Yep.
GCS.
Yep. The direct costs of producing what was sold. Materials, direct labor for a manufacturer, purchase cost for a retailer.
And sales minus COGS gives you
Gross profit or gross margin. Profit just from selling this stuff before other operating expenses, a key health indicator.
Next, SG&A, selling, general, and administrative expenses.
Right. All the other operating costs. Marketing, admin salaries, rent, utilities, stuff not directly tied to production.
Gross profit minus SG&A equals operating income. Why is that important?
Because it shows earnings purely from the core day-to-day business, before things like interest and taxes muddy the waters, many analysts see it as a reliable measure of core profitability.
Okay. Then you subtract interest expense.
Which is the cost of borrowing money.
And you get pre-tax income.
Exactly. Profit before the tax man takes his share.
Then income taxes, which is usually an estimate.
Often, yeah. The actual tax paid can differ based on various rules and deductions.
What are special items?
Unusual, one-off things. Selling a division, big restructuring costs, things that aren't part of normal ongoing operations but can hit the income statement hard. Investors watch these closely. And finally, the bottom line.
Yeah.
Net income, or net earnings, net profit.
The ultimate profit figure.
Pretty much. What's left after everything, COGS, operating expenses, interest, taxes is subtracted from revenue. This is what can be reinvested or paid out to owners. If expenses are higher, it's a net loss.
The guide mentions comprehensive income, too, briefly.
Yeah, it includes a few other technical items like unrealized gains losses. But honestly, most people, especially investors, focus squarely on that net income figure.
Okay, on to the next statement. The balance sheet. This one's different, right? A snapshot.
Exactly. Not over a period, but at a specific point in time, like a photo of assets, liabilities, and equity on, say, December 31st. It gives the full picture alongside the other statements.
And the core equation is assets, liabilities, plus shareholders' equity. Always has to balance.
Always. It shows that everything the company owns, assets, was paid for either by borrowing liabilities or by the owner's investment and retained profits, equity.
So it answers, what do we have assets? What do we owe? Liabilities.
And what's left for the owners? Equity or book value.
What are the main types of assets?
Usually split into current assets and non-current assets. Current assets are expected to turn into cash within about a year.
Like cash itself, accounts receivable, inventory.
Exactly. Cash, cash equivalents, short-term investments, money owed by customers, receivables, and inventory, raw materials, work in progress, finished goods.
And non-current assets.
Long-term stuff. Not easily converted to cash, land, buildings, equipment, maybe intangible things like patents or goodwill.
Okay. And liabilities are split similarly.
Yep.
Current and long-term.
Yep. Current liabilities are due within a year, short-term loans, accounts payable, money owed to suppliers, the current bit of long-term debt interest.
Long-term liabilities are due further out.
Right, like the main part of a long-term bank loan or bonds issued by the company.
And shareholders' equity is the owner's piece again.
Correct. It's the initial investment plus all the accumulated profits kept in the business, retained earnings, represents the net worth from the owner's view.
All right, third key statement, cash flow statement. This tracks actual cash.
Actual cash and cash equivalents moving in and out. This is crucial because, as we said, income isn't always cash. This shows if the company can actually generate cash and pay its bills. It's mandatory, just like the other two.
Why is it so helpful?
Investors use it to see operational efficiency, how well cash is managed. Creditors check liquidity. Is there enough cash to cover upcoming expenses and debts? A profitable company can fail without good cash flow.
And it's broken down into sections.
Usually three main ones: operating activities, investing activities, and financing activities. Sometimes a fourth for significant non-cash stuff.
Operating activities, that's cash from the main business.
Yeah, normal day-to-day stuff. Cash from sales, cash paid for rent, wages, suppliers. It also adjusts for changes in things like accounts receivable and inventory, because those tie up or release cash. There's a direct and indirect way to calculate this part.
Investing activities.
Yeah,
Buying and selling long-term assets.
exactly. Buying new equipment is cash out. Selling old equipment is cash in. Making loans to others, getting repaid. It's about investments in the company's future. Usually a cash outflow here.
And financing activities, how the company gets funded.
Right. Raising money by issuing debt, loans, or stock that's cash in. Repaying loans, paying dividends, buying back stock that's cash out. It's about the flow between the company and its financiers.
And these statements all link together, don't they?
Absolutely. The cash flow statement starts with net income from the income statement and then adjusts it using changes in balance sheet accounts. The final net change in cash on the cash flow statement should match the change in the cash balance on the balance sheet between the start and end of the period.
So it connects everything.
It really does. It gives insight into long-term strength, profitability drivers, and helps with future budgeting. Super important statement.
Okay, let's switch focus a bit to tax accounting, a specific area.
Very specific. It's all about preparing and handling taxes according to the tax laws, like the Internal Revenue Code here in the U.S. Applies to individuals, businesses, even tax-exempt organizations.
So the goal is tracking funds for tax filings and potential audits.
Pretty much. Making sure you have the right documentation and calculate the tax correctly based on the specific tax rules.
And these tax rules aren't the same as GAAP.
Ah, good point. No, they're often different. GAAP is for general financial reporting, making statements comparable. Tax accounting follows IRS rules specifically for calculating tax liability. Different purpose, different rules, different forms.
How does it work for individuals? Simpler.
Generally, yes. Mainly tracking income sources, eligible deductions, investment gains losses. You don't track every single personal expense, just the ones the tax code cares about.
So different from just personal budgeting.
Right. Personal budgeting tracks everything for your own planning. Tax accounting for individuals isolates just the tax-relevant stuff.
But for businesses, it's way more complex.
Oh, yeah. Tracking income, sure, but also a huge range of business expenses, depreciation rules, obligations to shareholders, all aiming to legally minimize the tax bill. That's why bigger businesses almost always hire tax specialists. The rules change constantly, too.
Even nonprofits need tax accounting. They don't pay income tax usually.
Correct, but they still have to file annual reports, like Form 990 in the U.S. They report where their money came from, donations, grants, and how they spent it to justify their tax-exempt status. It's about accountability to the IRS and the public.
Makes sense. The guide also mentions software to help manage all this. QuickBooks Online comes up first.
Very popular, yeah. Good for lots of different business sizes. Does the main financial statements, bills, invoices, inventory, budgeting. Payroll and payments are usually extra add-ons, though.
Different price levels.
Yep. Tiers like self-employed, simple start, plus, advanced. The plus version is pretty common, gives you those key reports: P&L, balance sheet, cash flow, plus 1099s, inventory, payables, receivables management.
Then FreshBooks, better for freelancers.
Often, yeah. Really strong on invoicing, time tracking, customizable invoices, online payments, project tracking, expense tracking, good for service-based solopreneurs.
But it doesn't do all the statements.
Right. It does profit and loss, but typically not cash flow or balance sheets in the same way. Its strength is really that invoicing and client management side.
How about Xero? Similar to QuickBooks.
Functionally similar, yeah. Often seen as a good fit for smaller businesses, maybe under 5 employees or so. A key thing is some plans include payroll for a small number of employees in the base price.
Which QuickBooks often charges extra for.
Exactly. Xero also has different plans: starter, standard, premium. The standard usually covers the main reports: P&L, cash flow, balance sheet, 1099s, inventory, payables, receivables.
And we have the free option.
That's its big draw: Great for businesses on a really tight budget, single-member LLCs, sole proprietors.
With the limitations.
Well, it does P&L and balance sheets, but bill-paying features can be limited in the free version, and critically, it generally doesn't offer a cash flow statement. But you can have unlimited users, which is a nice perk.
Good overview. Lastly, the guide has some practical tips for new small business owners diving into accounting. First one, KISS. Keep it simple starting out.
Ha, yeah. Good advice. Maybe start as a sole proprietorship. It can simplify things initially, especially with IRS filings. You can always change structure later if needed.
And definitely separate personal and business expenses.
Absolutely critical, especially for sole proprietors. Use separate bank accounts, separate credit cards. Makes tracking so much easier and avoids trouble with disallowed deductions at tax time.
Track all business expenses, even small ones.
Yep. Document everything. You never know what might be deductible. Keep those receipts or digital records.
Have an accurate way to record deposits. Don't lose track of income.
Vital. You don't want to underreport income, but you also don't want to accidentally overpay taxes because you lost track of what came in. Maybe get some advice on a good system for your business type.
Consider hiring a pro, even for a little bit.
Highly recommended. Even just a few hours with a bookkeeper or accountant can set you on the right path, ensure accuracy, maybe find deductions you missed, and they can explain things clearly.
Dedicate regular time for bookkeeping. Don't let it pile up.
Please, yes, schedule it. Weekly, monthly, whatever works, but stick to it. Avoids overwhelm and keeps records current.
Monitor labor costs closely if you have employees.
Definitely. Wages, overtime, benefits, perks, it adds up fast. Need to track it accurately to manage costs and comply with regulations.
Set money aside for big, infrequent expenses, like taxes.
Smart move. Taxes, replacing equipment, major repairs. Plan for them. Sock away some money regularly so you're not caught short when the bill comes due. Helps manage cash flow.
Maintain inventory records if you sell products.
Crucial. Track what you bought, when, what you sold, stock numbers, prices. Helps prevent loss or theft, keeps you organized, helps manage stock levels.
And finally, follow up on invoices. Get paid.
Yes. Don't let receivables age too long. It hurts your cash flow. And you might even pay income tax on money you haven't received yet. Use software, send reminders, make it easy for people to pay online.
Wow, okay. That was a pretty thorough tour. So there you have it, you. A comprehensive deep dive into bookkeeping and accounting, all based on that accounting step-by-step guide you sent over.
Yeah, we really hope this has clarified things, maybe demystified some of the jargon, and given you some valuable takeaways for understanding business finance.
We really encourage you now to think about how these ideas, these foundational concepts, apply to your own interests or situation. Maybe understanding a company's health better, managing your own money, or even
thinking about starting your own venture. It gives you the language.
Exactly. And that brings us to our final thought for you to chew on. Now that you have a clearer picture of this financial language of business, what new questions does it spark for you? Maybe about how organizations really create and manage their value in the world.
Interesting question to ponder.
Definitely. Thanks so much for taking this deep dive with us.